Hello everyone, welcome back to this video. Back and today we'd like to discuss about the 5512 financial market institutions. Topic 5 debit date market 1 short-term dates. Thanks to Evelyn Lifers. So today we'd like to discuss the market and explaining the short-term dates. So let's begin. So short-term dates is a financial arrangement for a period of less than 1 year, with various characteristics to suit borrowers to particular needs. It has when it has the timing of repayment, risk, interest rate structure, sort of funds. So the matching principle is short-term assets should be funded with short-term liabilities. So there is some. So there are two types of tradable securities: negotiated certificate deposits, commercial and bank accepted bill, and promissory notes. And the next, and on the right is the non-tradable sources: trade credit, bank overdraft, inventory finance, and accounting receivable financing, factoring. So first, we like to discuss about the short-term tradable securities. There are three types we like to discuss in the following slides. The first is the negotiable certificate or deposit. It's a short-term security issued by banks to manage their liability and liquidities, and it is issued a discount to its face value, and maturities range up to 180 days. Issued to institutional investors in wholesale money markets. The short-term money market has an active secondary market in negotiable certificate deposits. The key information is that the negotiable certificate of deposit (NCD) is issued by a bank and is at a discount. Second one is the commercial and bank accepted bill. It is the security issued by with a face value payable at the future date at a discount. A commercial bill is a bill for exchange issued to the right fund for general business purpose. It's a bill that is issued by a corporate and incorporates the banks as acceptors. So the key features of the commercial and bank accepted bills is that it is issued a discount and issued by a corporation. Yes, we can see this is a typical form of the commercial and bank accepted bills. Next, let's drawer acceptor and the payee discount endorser. So we'd like to pay attention to discounter, the provider of the lender of fund. So we can see that the jeweler is the issuer of the bill, acceptor is usually the bank, the corporation issues the bill, and the bank takes the primary responsibility to repay the face value to the holder of the bill at maturity. Payee, the party who receives the funds. Typically also the jeweler, but the jeweler can specify secondary level for repayment to after acceptor. So I think it's the form of bank accepted bill. So it says that to ABC Bank Ltd accept date of December payable at the thermal bank ABC Bank for Bahama. So we can see the acceptor is ABC Bank. The date of exhibition placement of the jeweler is the borrowing corporate Ltd. So it is the borrowing. It is the Bank accept the bill issued by ABC Bank Ltd. Correct. So the advantage of the commercial bill financing is that lower costs than other short-term borrowing for borrowing costs determined at issue date and not affected by subsequent changes in interest rates. A bill line is an arrangement, but a plan, but the bank where it agreed to discount be progressively obtained. A bill line is an agreement with the bank where it agrees to discount bill progressively up to the agreed amount. Term loan may be extended by rollover at maturity. A bank provides both the bill acceptance facilities and the bill discount facility. The last one is promissory notes. Discount securities issued in the money market with a face value payable at maturity, but sold today by issue for less than face value. Issue the discount to its face value, also called commercial paper, typically available to companies with excellent credit reputation because there is no acceptor or endorser and are issued as unsecured instruments. So the key factor of this one is also at a discount, but it is available in the secondary market. It is tradable. It is very frequent. Issue of promissory notes can be underwritten. Underwritten guarantees the full issue of notes is purchased. Underwriter is usually commercial bank, investment bank, or merchant bank. A fee is charged by the bank for underwriting progress. The underwritten issue can incorporate a rollover facility, effectively extend the borrower's line of credit beyond the short-term line of the promissory note issues. Issue may also be underwritten. Issue may approach money market directly. Commercial bank, investment bank, or merchant bank may be retained as leader management and receive fees. So there was two methods to issue the promissory notes, underwritten and ununderwritten. It depends. And next, we like to discuss a short-term tradable security the calculation. So some knowledge of financial mathematics is required to do calculation of discount date security. Formula and calculation are the same for different types of discount security issued into the money market. So we need the price where yield is known, face value where is the price and yield is known, yield, discount rate. So the price, so the calculation price is the cash flow, expect cash flow with the required rate of return 1 plus rate of return power t accumulated. It's a very basic price function. So formula to calculate price of discount security, well, the yield is known, is face value times the days in the year, add the yield divide 100 and times days to maturity. That's the detailed functions. So I like to explain it to you when we was in week 5 examination. Yes, and next is short term. Next is the calculation of the face value. So we need to know the face value where the issue price and the yield is known. When we know yield, we can calculate the price. And we know issue price, we and the yield know, we use face price. Face value is 365. Add the yield, divide 100 times days to maturity, divide 165. So it will be 1 plus something else. The fixed price will bigger than the issue price. Another yield. The yield refers to rate of interest on the amount paid to purchase discount security. Formula to calculate yield of discounted security is share price minus the buy price divided by price times the day in the year times 100 divides the days to maturity. It is a percentage amount because you times 100. The discount rate is expressed in terms to the face value of the security, while the yield is expressed in terms of the purchase price or current price. Formula to calculate discount rate of discount security, where the face value and the current where the face value and the current price is known. Discount rate is the face value minus the current price. Fixed price, current price divided by the face value, and the time in year divided the days to maturity times 100. So the difference from discount rate and the yield is in yield it is sale price and their buy price, and in discount rate is the face value and the current value. Yeah, that's calculation for the short-term tradable security. Now we'd like to the short-term non-tradable facing financing sources. On the right hand, there is the first one is trade credit. So a supplier provides goods to or service to a purchaser with arrangement for payment at a later date, offer increased discount for early payments. So from provider's perspective, it's increased sales, but cost of discount and increased discount period, increasing total credit period and account available receivable, including collection and bad debt costs. So the trade credit purchase has a choice of either paying early and receiving a discount, or paying full by a later date and obtaining a longer period of credit. Opportunity cost of purchase foregoing the discount on the invoice. Opportunity cost is discount rate divided 100 minus 100 percentage of discount times 365 divided days difference between early and late settlements. It is beneficial to pay early when the purchase can often find at after-tax rate or less than opportunity cost, when the surplus cost that has on an alternative use has less after-tax return and opportunity cost. Actually, I'm not fully understand this. In our last lecture, our professor said she would discuss this on the workshop, but I missed the workshop, so I need to make it more clear. Maybe there is question on the quiz, on the exam quiz and exercise question. Pay attention to this. And then is the bank overdraft. Overdraft facility is the major source of short-term finance. The financial place its current operating account into deficits up to the agreed limits. Generally operated on a fully fluctuation basis. Lender may also impose established fees, monthly account service fee and the fee on the unused overdraft limits. Bank overdraft interest rate negotiated with bank at a margin above indicator rate, reflecting the borrower's credit risk, hazard financial performance and future cash flow forecasts. Length of mismatch between cash flow inflows and outflows. Adequacy of collateral. Collateral is the assets that are used for back you loan. Third is inventory finance, accounts receivable financing, and factoring. Inventory finance is the most common form in floor plan finance, particularly designed for the need for motor vehicle dealers to finance their vehicle or to finance their inventory finance. Dealer expect to promote financial products, and inventory finance account. And next is accounts receivable finance. A loan to a business secured against its accounts receivable. Who are its debater? Mainly suppliers by financing companies. Lender company take charge of the company's accounts receivable. However, the borrowing company is still responsible for the dates, bulk, and bad dates. Factoring is company sell its accounts receivable to the factoring company, often at a discount to risk finance. Factoring provides immediate cash to the company as well as removes administration costs of accounts receivable. Main providers are finance companies. The factor is responsible for collection of receivables. Factoring company is required to notify its customer that payment is to be made to the factoring state. There are two main types of factoring agreements: the recourse arrangement and the non-recourse arrangement. Recourse factoring has a claim against the company if the recovery is not paid. Actually, the discount of the factor will be much higher if the arrangement is the non-recourse arrangement. I said recourse arrangement because most of money can be secured. Yes, the conclusion. It's a discussion about the short-term tradable security, calculation of short-term tradable security, and the short-term non-tradable financing sources. That's all about today's lesson. Goodbye.